Welcome back to the deep dive. Okay, today we're doing something a bit different, a custom deep dive focusing on, well, some pretty extreme uncertainty, the potential U.S. government shutdown looming in 2025. We've got a listener request here, backed by some solid sources, looking at not just the politics, but the immediate technical threat to markets. So our mission today is really two things. First, unpack this whole crisis of an economic data blackout. You know, what happens when the lights go out on the numbers everyone trades on? And second, we need to contrast that short-term kind of chaotic volatility with, let's say, the more proven fundamental factors that actually drive key commodity prices like crude oil over the long haul.
Yeah, and it's crucial to understand just how close this is. I mean, the hard deadline for funding is 11:59 p.m. Eastern Time, September 30th. That's right around the corner. And people often think, oh, shutdowns, that means national parks close, right? But the bigger issue, definitely for you as an investor, is the complete halt of these critical federal statistical agencies. That shutdown guarantees a period of, well, profound uncertainty. And we all know uncertainty is basically kryptonite for markets that depend on steady data flow.
Right, kryptonite. So let's dig into the mechanics of this data vacuum. How does it actually happen? We looked at the Department of Labor's own contingency plan, and it's pretty stark. It calls for a complete cessation of operations at the Bureau of Labor Statistics, the BLS.
And that's really ground zero for market panic. The BLS, I mean, it's the engine room for economic transparency. Complete cessation means everything just stops. Data collection, processing it, putting it out there, even website updates gone. And think about the people, nearly 13,000 BLS employees are looking at furloughs, maybe even permanent layoffs, just as we head into a really critical economic quarter.
Okay, so markets thrive on predictability, those scheduled data releases. What are the immediate reports, the really big ones that are now on the chopping block?
Well, the heaviest hitters are the ones measuring the economy's pulse, right? The employment situation report, everyone knows that is non-farm payrolls. That's due October 3rd. Then just 2 weeks later, October 15th, we're supposed to get the Consumer Price Index, the CPI, our main inflation gauge.
Yeah.
And it doesn't stop there. The Producer Price Index, PPI, and the Jolt test report on job openings also threatened. It's a big chunk of the essential data flow.
So how does this lack of data affect the Federal Reserve? I mean, aren't their decisions totally data dependent these days? How much does this hamstring them?
Well, massively. It creates a huge visibility problem. Without these key September numbers on jobs and inflation, the Fed is essentially flying blind. This lack of reliable, high-frequency data just throws a wrench into their whole data-dependent approach to policy. Sources we looked at show analysts already saying this boosts the chances of an October pause on interest rate decisions. How can they commit to a path for cuts, or hikes for that matter, without the necessary data? They really can't, not confidently.
Now, this has happened before, right? But what does history actually tell us about how long these delays last?
Yeah, we can look back. The 2013 shutdown, that was 16 days. It pushed back the jobs and CPI reports by about 2 weeks. Okay, frustrating, but maybe manageable. But then you have the longest one, the 35-day shutdown in 2018-2019. That's where you see the real danger. Commerce Department reports things like GDP, income data, they were delayed by roughly a full month. And these delays, they don't just, shift dates on a calendar. They genuinely distort how markets behave for weeks afterwards.
Okay, so shifting gears slightly from the data gap itself, what about the direct economic hit, the drag on the economy?
Right, that's the other immediate impact. Economists are projecting a direct hit to GDP growth. We're talking 0.1 to 0.2 percentage points shaved off for every single week the shutdown goes on. And that drag comes mainly from the furloughed workers, right?
Yeah.
The estimates are around 800,000 to maybe 900,000 federal employees being sent home without pay.
But there's something different this time, isn't there, compared to past shutdowns? Something about the nature of these layoffs. Usually, workers expected back pay eventually.
That's a really critical distinction, yes. The sources we reviewed indicate the current administration told agencies to actually prepare reduction in force plans, REF plans. And you need to understand, an REF isn't just a temporary furlough where you wait it out. It signals a real risk of permanent layoffs. And that uncertainty, the fear of actually losing your job for good, not just waiting for a delayed paycheck that would likely hit consumer confidence much, much harder than these temporary budget fights we've seen before. It feeds directly into national payroll numbers, too.
Okay, before we jump fully into market reactions, we have to briefly touch on the political friction here. We need to stay neutral, obviously, but what's the core policy disagreement the sources point to?
It really centers on healthcare funding specifics. The main sticking point seems to be Democratic demands to roll back proposed cuts to Medicaid, and also extending tax credits linked to the Obamacare plans. So it's fundamentally a disagreement over how certain social safety nets are funded. And without a deal on a stopgap measure, what they call a continuing resolution, and importantly, lacking the votes to clear a Senate filibuster, the funding just lapses automatically.
Okay. So uncertainty spikes, funding lapses, market scramble. What are we seeing right now? What's the immediate reaction you should be watching?
Well, the clearest signal, maybe unsurprisingly, is gold. It surged, hit record highs past $3,850 an ounce. It's playing its classic safe haven role perfectly. But it's not just the shutdown jitters. It seems to be fueled by really three things. This immediate uncertainty, yes, but also a generally weaker U.S. dollar, and this ongoing trend of central banks around the world diversifying their reserves, moving a bit away from the dollar.
But that leads into currencies, right? The dollar weakening.
Exactly. The U.S. dollar index, the DXY, it's weakened against other major currencies like the yen, the euro. It makes sense. Political instability like this tends to erode international confidence in, U.S. governance and the stability of its debt. What's interesting, though, equities. Stock markets have been kind of mixed, maybe muted initially. Analysts are pointing to history here, noting that market dips during past shutdowns were often pretty shallow and short-lived. So maybe investors are betting this is just noise that'll pass.
But if the official data feeds are cut off, how do policymakers and big trading firms even operate day to day? They can't just stop analyzing.
Right. No, they pivot
Yeah.
immediately. Volatility is expected to jump. That's almost a given. And everyone, policymakers, firms, investors, is forced to rely on what our sources are calling less comprehensive private sector proxies.
Mm-hmm.
So think things like the ADP payroll report suddenly becoming much more important because the official non-farm payrolls aren't there. Or using alternative inflation measures built from private data sources. It's a practice called nowcasting, trying to figure out what's happening right now without the official lagging indicators.
Using proxies, though, that sounds risky. Are they as reliable as the official BLS data? What are the dangers there?
That's the big worry. And it leads straight to this risk our sources call revision whiplash. Because look, the private data often isn't gathered with the same statistical rigor as the official stuff. Plus, you have actual gaps in official data collection during the blackout. So when official reporting finally resumes, the numbers might be skewed or incomplete or just, weird. They might need huge statistical revisions down the line. Revision whiplash is when the market thinks the economy is doing one thing based on maybe shaky proxy data, and then bam. Weeks later, the revised official data comes out, tells a totally different story, and the market has to violently adjust. It can be messy.
Okay, right. Messy indeed. So let's pull back now from this immediate high-frequency chaos. The shutdown feels like a flash flood of short-term noise. But we need to remember the deeper currents, the fundamental economic factors that reliably move major commodities like crude oil, specifically West Texas Intermediate, WTI. Contrasting this political noise with those proven quantitative drivers feels really essential right now.
Absolutely. And we did dig into that, analyzing robust data over a good stretch monthly data, 2009 right through 2021, to see what really moves WTI prices, regardless of the drama in D.C. And interestingly, a couple of factors consistently showed up as the most reliable drivers across the statistical models we looked at.
Okay, let's hear them. What are the two most robust factors influencing WTI?
All right, the first one, identified as the single most robust factor, is global imports of crude oil. Let's call it Crude. Now, what's maybe a bit counterintuitive here is that it shows a slight but very consistent negative correlation. What that suggests is when the total volume of oil being imported globally slightly increases relative to exports, that subtle shift in global supply puts a tiny bit of downward pressure on prices. It's like a constant subtle weight on the price lever reflecting global inventory builds.
Interesting. So global supply-demand balance at the margin is number one. What about the broader economic picture?
That brings us to the second really robust factor, the S&P 500 index. This one showed a consistent, pretty strong positive correlation with WTI prices. And this link is key because it connects energy prices directly to general market sentiment and economic activity. When the S&P 500 goes up, it usually reflects optimism, stronger economic growth expectations, which implies more future demand for energy for everything from factories to driving. Essentially, the market sees the S&P 500 as a decent proxy for overall global economic health and therefore future oil demand.
So Crude and the S&P 500 are the heavy hitters, but the analysis also pointed to two other critical global factors, right? One's tied more to specific economies and currency effects.
Exactly. One that showed a really powerful positive influence, particularly in certain models, was China's GDP growth. We called it GDPCH. The analysis basically confirmed what many suspect. As China's massive economy expands, its enormous appetite for resources, especially oil, acts as a major force pulling WTI prices higher. China's energy demand is just a huge factor on the global demand side.
Makes sense. And the last piece of that puzzle, the currency effect. We touched on the dollar earlier.
Right. You can't ignore the global pricing mechanism. The U.S. dollar index, the DXY, came through as another powerful, reliable influence, often working against those demand factors. The DXY showed a significant negative correlation with WTI. And the logic is straightforward economics, really. Oil is priced globally in U.S. dollars. So when the dollar strengthens, oil automatically gets more expensive for any country using euros or yen or whatever. That price increase tends to dampen global demand, which in turn usually pushes the nominal WTI price down. It's a constant push-pull.
Okay, so bringing it all together.
Well, the bottom line seems to be, whether you're trying to navigate the immediate storm of this potential shutdown or you're trying to track the underlying fundamentals for something like oil, the biggest challenge right now isn't just the volatility itself. It's the quality and the timeliness of the information you have access to.
Yeah, it feels like we're living in two parallel realities at the moment. You've got the markets reacting instantly to the shutdown fear, scrambling for safe havens like gold, and trying to make sense of these potentially noisy private data proxies. But underneath all that surface chop, the fundamental drivers, things like global crude flows, the S&P 500, China's growth, the dollar, they're still operating, still shaping the long-term trends, kind of patiently waiting for this political storm to pass. So here's the final thought to maybe chew on. The official reports, the jobs numbers, the CPI, they will eventually come out, even if they're weeks late. But given everything we've discussed, the data collection gaps, the processing delays, the higher odds of really big statistical revisions later, that revision whiplash, what kind of unexpected economic shock might be hiding in those delayed numbers when they finally surface? And how fast will markets have to pivot to catch up with the real picture of the economy once that official, albeit potentially heavily revised, data finally emerges? Something to keep a close eye on as we approach that September 30th deadline.